And we are live, and good morning to all, and good morning to everyone. We are live. Good morning to you, Stephanie, and how are you doing?
Of course, we
Okay,
good morning
well,
to
we
you,
are.
Munyumba. How are you? I should say it's a very good day. Happens to be the midday of the week, and I'm excited to be here to get to look at what's happening on the market. But just before we get started, we are also live on Facebook. That, of course, is Money FM Zambia 93.7. Also, for your comments and questions, we open up the phone lines on 077 I should say, Munyumba, you look quite excited. I could almost tell that the topic is exciting today.
Well, it's Wealth Wednesday, so it is. It is. This is my central focus,
Have
and it is
Munyumba
my
on the other
excite.
side. Something looks to be off.
No, no, fine. I think, yeah, I'm saying, well, it is Wealth Wednesday. It is my excitement day. This is the day that I'm fully tuned in, and this is where you get the best of me. So I did take a little bit of a snooze, people, and I am back fully in full effect. Today we're going to be covering
Something
some
looks
of the
a
market.
little bit
Sorry, Stephanie, it's on your side.
off on the
It's
other
actually on your side.
side.
Yeah.
Let's see if I could get to see what it is.
Right. So just as we're getting back into the main.
Not really with the network, but yeah, I think we're good. Say something again. Let's see if we're able to get to see it.
Yeah. Okay. So let's get fully in. So now, starting with the news on today's Wealth Wednesday, we'll be going through a few issues today regarding the market analytics. We'll be going through some market data, generally the FX markets and how they're doing, stock markets, everything all together. We'll be getting a bit of market news, but the main big stories that we'll be covering today is actually the medium-term budget, which is the green paper. I'm going to be doing an analysis of the green paper going forward, and then afterwards, we're going to be going through our topic of discussion, which is called risk-balanced investing. We've been trying to get through that topic. I think we missed it up last time. Simply because there was a bigger topic that did come in. This being a news station, we do sometimes have things shuffle along the cycle. But the topic of discussion today will be risk balanced investing. That's going to be the big discussion about how to create a balanced portfolio and where we started from last time. So let's cut into today and start going through some of the market analysis on the roundup. Now, handsome fella is telling you 19th of July 2023. We are already heading through the 7th month of the year. Please take a look at where you are, your plans, your businesses. Where are we going in terms of our economic affairs? Now, coming up on the market roundup, we did see that the kwacha in the wholesale market, the dollar did close at about 18.9938, 0.52% up from yesterday, 2.59% up from the last week, and 1.89% down on the week,
Just to
4.96%
join us,
up year
due
to date.
code 077
Sorry, Stephanie. I think the issues are happening on your side. It's the network actually happening on your side. So let's get back to it. So we are seeing that the market. Back into it. We are seeing that the dollar is up 4.96% year to date. We do see that the Lusaka All Share Index yesterday did move up about 0.04%, mainly due to the fact that we did see CEC shares move up 0.2%, mainly on news of CEC and ZES and CEC and KCM reaching a settlement, and how that will affect the balance sheet of CEC. 7 days, we have seen that the All Share Index is up 0.3%, and year to date up 12.17%, with the bond index up 0.07% and the US dollar bond index down 0.45%, mainly because we are seeing, mainly because we did see that the FX rate is still weakening, while interest rates are slowly starting to slide back down to 24.15. Now, moving into some of the main news, some of the main analytics. we're still seeing this boomerang effect happening where the exchange rate is probably heading back up to that 19.05 mark and heading back upwards to the 20. Remember that we're still negotiating our debts with our private creditors. Until then, we do not get a stronger rating, which is supposed to bring in inflows. Going forward. Obviously, on the week, we do see it's 2.95% and year to date 4.96%. We're 16% away from all-time highs of the FX rate. Now, on the rand is where we're actually getting a beating right now, and this is bad news for us because of import prices. Remember that we import from South Africa. Rand is up. Rand is closed yesterday at 1.1, mainly due to South Africa's stronger credit rating. The affirmation of their B- credit rating still gives them a stable outlook going forward, and also projections of the Federal Reserve slowing down rate hikes and only having one more rate hike probably for the rest of the year. Let's put the rand up 9.53% against the kwacha on the week and 3.77% against the kwacha on the month, putting it against all those who are doing cross-border trade with South Africa, probably experiencing some fluctuations in price, and this will probably start to now cover onto the consumers of these cross-border traded items. So we do see a little bit of imported inflation that might be coming through the South African exchange rate. Now, in terms of the bond index, we have a straight line movement. Year to date, it's up 14.59%, meaning secondary traded bonds actually been moving up 0.07% as of yesterday, and 1.89% still in the last 30 days. So we have seen a stable movement in the bond index. Over the last 365 days, the bond index is up 24%, which is giving you a good index reading that your bond market is doing decently above inflation. Now, on the other side of things, we're also seeing that the GRZ bond index in dollars, unfortunately, is coming down due to the weakness of the kwacha over the last period of time, because we have not concluded our creditor negotiations. We've concluded our official creditor negotiations. Now we have to conclude with our bondholders, and then that is what can start to stabilize the USD bond index. Now, on the other side of things, we're also seeing that the interest rate is also seeing about 24.16, down 0.002%. As we're seeing 0.51% up year to date in terms of interest rates, meaning that bonds have still been a sell on the year, but they are still relatively strong in terms of yields. Now, on commodities, we did see that copper, which was roaring at about 8,700, has come back down to 8,466. Obviously, weak Chinese data is still concerning to the rest of the market. While we're still also seeing oil in the USD has also touched that 70 mark. We'll be giving our expectations of the end of the month on Friday. Please tune in. That's the 21st. We always give you our projections for what we see the ERB probably doing at the end of the month. And we also are, for the end of the month, we'll be giving you that on Friday. And also gold in USD is up 1.17%, also due to recession fears that are still lurking through the global economy. We also did see that wealth insurance assets, Bitcoin did take a little bit of a dip. It's back below $30,000 at $29,000. And we're still now in kwacha, it's down 0.9%. And also Ethereum is down 0.6%. Obviously, the broad market crypto sell-off that's actually starting to happen. While in kwacha, gold is up 1.69%. Now, you do see that your Bitcoin and Ethereum have been stronger stronger year to date. But just always remember, these actually were the worst performing assets in quarter two. All of this is really just a sign of quarter one's rally that happened. But quarter two has pretty much been poor for them. And that is why they look strong, but they really are still in a very soft patch right now. Bonds up 14.6% year to date. Stocks up 12.2% year to date. Dollar is up 5%. Gold is up 13%. We're still in a relatively defensive position where we are still seeing slightly elevated inflation with slow economic growth. And one of the big stories that's going to pound on is what the medium-term outlook is, but also closing down our four horsemen outlook. From today is that we saw that Italian CPIs were up 6.4% yesterday, while American capacity utilization was dropped to 78.89, while we also saw that U.S. crude stock dropped by 0.8%. Now, this inflation data is showing that the world has still got a little bit of sticky inflation baked into it, and mainly that's due to supply chain still trying to wash out the shock of the pandemic shock and also the Russia-Ukraine war. At the same time, we saw UK bonds and German bonds also auction at elevated rates. They did not rise; they're still elevated, but they've at least slowed down in terms of rising. US retail sales were up 0.2% and 1.5% on the month-on-month and year-on-year, while US Red Book was down 0.2%. Business inventories also came in slow at 0.2%, and US retail sales again. Sorry, I think that was a little bit of a mishap there. Came in 0.2% with a little bit of a misread there. Canadian housing starts rose to 281,000 in the industrial sector, but we're getting weak industrial data in America showing that industrial production is slowing down, manufacturing is slowing down, and the housing market is also slowing down. So all this slowing down that's happening in the global economy is actually starting to affect a lot of the mainstream asset classes. So this is what we're still dealing with: elevated inflation, elevated interest rates, but we're seeing international trade slowing down and industrial demand slowing down. So this is going to reflect in slowness in the global economy. And this opens up to our special issue for today, which is the 2024 to 2026 Green Paper Outlook. In other words, this is the medium-term budget, and where we're going to be looking at what actually happens from 2024 to 2026, the budgeting strategy of the government, and just some highlights that we're trying to pick up. So this is the summary table of where we have come from and what we're expecting at the end of this year. Real GDP grew 4.6% in 2021, 4.7% in 2022, but it's expected to unfortunately slow down to 2.7% in 2023, mainly due to slowdowns in agriculture, energy, and mining, especially mining. We are pretty much now in a we've almost gone into a mining recession. And at the same time, that's taken us into an export recession because our export growth has been negative for a long time now. So exports have been doing horribly in terms of where they've been for the last couple of quarters here. Especially since quarter 2 2022. So exports have been relatively weak. We're also seeing that on the flip side of things, inflation is starting to slow down, and it's expected to finally get into range, or at least around 9.1%. That's what we're thinking. Bank of Zambia is still seeing it around 10.2%. We'll be waiting for next month's Bank of Zambia statement, but this is what we're effectively seeing. Budget deficits are expected to finally come into a closer range of 7.7%. Remember, we need budget deficits somewhere around 5%. Copper price is expected to stay around the 8,500. As you can see, that's what's also dragging economic growth, while copper production is expected to sink from 700,000 to 682. So we're not even expecting this 2 million ton target by the end of 2026. I think that has been revised going forward. The expectation also is that crude oil is expected to continue going around $92 a barrel by the end of this year. So this is the expectation. Elevated oil prices, sagging and depressed copper prices have led to depressed growth, but at least we're managing to hold off inflation. That is the expectation for this year that we are seeing. Now, in the projected period, we are expected to rebound in economic growth in 2024 to 4.8%, and then 4.3% in 2025. And then from there, 2026 is where we should start seeing the 5% economic growth. Remember what I said? On the other side of 2026 is where you expect copper prices to probably take off fully now. Especially on the side, I know we've pretty much kept them at 8,500, but on the other side is where you expect copper prices to really take off fully now, mainly due to the electric vehicle run, and also you expect oil prices to start sliding down. So we've held copper prices low, we've kept oil prices up. We're doing prudent accounting here, but the expectation is you should see upside growth on the other side. Expectation also in 2026 is that we'll be deep into our 7% range, where we'll now be back at around 7% inflation. That should bring down interest rates. That should stimulate a lot of growth in the economy, with copper output expected to come back, heading towards that 1 million mark by 2026, heading to 2027. So that's probably now when we're going to see a ramp up in copper production. So it looks like what we're citing is 2023 is supposed to be the low in copper production. Copper production should be back up to 796,000, which is the number greater than last year, 796,000. with an 8,300 copper price, and then back to 860,000, then back to 939 with an oil price expected to stay around 80. Probably around 2028 is when you see oil prices now fully start to swing downwards. But there's pressure now starting to build on downwards oil prices. So this is the projected macroeconomic environment going forward. And this is what we should all be banking our stock markets on, our stock market bids on, our bond portfolios, our business. This is the macroeconomic environment you keep an eye on and you start measuring with. When you're doing your household budget, factor in a 7% inflation. Look at the growth levels that are happening in the economy. Look at the expectations of FX rates. So you probably will see FX strength start to pick up somewhere around 2024, 2025. That's probably when you start to see the FX rate now become a lot more stern and stable, probably now wobbling around a very tight range like it did from 2008 after that recession onwards. Now, here's some of the biggest things that we did see. Growth in 2023 is projected to slow down to 2.7% from 4.7% recorded in 2022, mainly attributable to reductions in output in mining and electricity, which are both expected to contract 8.7% and 2%. So we're expecting the mining industry to be 8.7% smaller than it was last year, and the electricity sector to contract by 2% also this year. Overall growth is expected to be mainly driven by ICT, manufacturing, transport, and finance. These are the areas of growth you're expecting in the economy. Mining, unfortunately, is not going to be a strong one this year. So this is why I've been talking about positioning yourself for the mining stock growth for 2026 onwards or 2025 onwards, mainly because that's when you'll probably see stronger prices and a stronger growth outlook. But for now, there's a lot of investment happening in the mining sector, but not much in terms of economic activity and growth as of yet. So expect 2023's economic growth to drop from 4.7% of 2022 to 2.7%. So remember that if you've got slower growth and elevated inflation, which we still have, that is where what we call your stagflation assets come to play. And your stagflation assets are your bonds, gold, some of your cryptocurrency, but it's bond heavy. It's short-term inflation flexible bonds. And that is 2, 3, 5 year. Those are short-term inflation flexible bonds. And that's what we've been, people. We've had elevated inflation and sluggish growth for the last about 4 or 5 years. That is why the bond market has been the buy. Okay, and that's why your main asset groups, whether your pension funds, NAPSA, so forth, they are very sticky in the bond sector right now because they are dealing with slow growth and elevated inflation. And that is where you get a lot more return on your assets in your bond portfolio. Your stock portfolio will probably only pick up. So this is where you may find you have to start looking for bargain stocks now if you're going to start ranging into it, or you start slowly dripping into your unit trusts, your equities unit trusts at the moment. Now, this is where the outlook of growth is supposed to be, and this is how the map is supposed to look. We are 2021, 4.6, 4.7, and we'll be bouncing back. So it's a little bit of a boomerang, mainly because 2023 has been a mining recession, dragged down by the mining industry and the agricultural industry and energy industry. The key sectors of our economic plan, unfortunately, have been pulling us down. Although I will also add that one sector of the economy that is also contributing strongly to growth but does not seem to be singled out is actually the education sector. Education has been one of the higher growing and higher contributing to economic growth as well. And we're also looking at tourism in terms of the tourism rebound that is happening. Remember, there's a lot of travel. Travel is hitting record levels, so it's almost fully recovered. Airline travel, international travel, because there's a lot of travel happening around the world. Tourism is also expected to do very strong in this period. We even saw it in Pamodzi results where they fully recovered going forward. So in terms of the growth, I think this is a bit more of a mundane growth outlook. It's not really a full positive outlook, but I think they're also trying to make sure that they manage economic expectations going forward. Now, the other things that we're seeing where the main policy growth is expected, policy measures that the government is going to look for is measures that will support economic growth, increased investment, and restore and maintain fiscal stability. In other words, what they're trying to say as the government is, We want the economy to grow so that the government budget does not grow from borrowing, but from tax growth. And they're not trying to increase the tax rate, they're trying to increase the tax base. So all of their policies are not aimed at an increase of the tax rates for redistribution purposes. They're trying to incentivize the growth of the tax base so that we move on to a bigger budget, mainly driven by taxes and tax revenue rather than borrowing. So in the medium term, these are the areas that they're looking for growth over the next of the next period. Agriculture is expected to grow 4.3% from 2024 going up to 2026. Manufacturing 3.1%. So manufacturing is expected to slow down from where it is at the 5%. Energy is expected to only grow by 0.3%, but as you can see, tourism is expected to grow by 14%, transport by 6.9%, and ICT by 7.6%. So you can really see the hot growth areas tourism, transport, ICT. Also, I also believe that that education should be strongly in there, because especially tertiary education. Tertiary entities are really a fast-growing sector. In fact, all the growth in the university populations of Zambia has actually come from private universities. That's a fact that most people don't want to pay attention to. The public universities have actually stayed the same in size. It's the private universities. In fact, Stephanie, you're part of the youth that's out there. Isn't it now a new trend that more of your friends are actually going to universities outside of the standard UNZA, CBU, if I'm correct?
Mm.
Yeah. So you heard it first from our own Vayuth sitting in our panel here. All right. So now let's move into some of the expectations of inflation. Inflation is expected to continue trending downwards in 2023. Expected in the first 6 months, inflation decelerated to 9.8% from an average of 12.3% in 2021 and 2022. The reduction in inflation is on account of a slowdown in food and non-food inflation, including fuels and lubricants. I think the key driver has been the transport inflation. That's been the main one, and that's obviously because the Russia-Ukraine war effects have started to slow down, and oil prices went from that $120 down back to about $70, $80. So we're back at a normal range. So this is what we expect inflation to start looking like over the next 5 years. We're sitting at 16.4 in 2021, and you can see that it's now slowly trying to track downwards, 9.9, 9.1, and it's now heading towards, it's scheduled to head towards about 7 by 2026. So these are the projections. As at the end of this year, we put about 9.1, just kind of averaged out as the average of all the returns. Now, what is the government strategy? If you are a bond investor, okay, you have to pay attention to this part. What is the government's financial strategy heading into these next 3 years? So the government is saying they're going to focus on tax compliance. They're going to try and make it easy for people to pay taxes, so that they're hoping to actually earn more money that way by improving the tax system. So they're looking at electronic tax invoicing, streamlining of tax incentives, digitization and integration of government systems, and the formalization of the precious metals mining sector. And the goal is to increase domestic revenue to 22% of GDP by 2026 progressively, and they're looking to narrow the deficit. So in other words, increase revenue, decrease expenses, and mainly they're going to be targeting debt payments. Okay, they really want to target slowing down of paying debt. Because I know the moment people start hearing that the government wants to curb and hold expenses still, all of a sudden everyone starts panicking. Be it civil servants start thinking they're not going to get increments anymore. Tough luck, people. And also, be it people think that there's going to be cutbacks on spending in areas like education and health. What you'll notice is that those areas will remain flat. What they're just looking at is they're looking to increase the top line growth of the government through a growth of the base, not an increase in taxes and not borrowing. So they want to strengthen tax policies, improve taxpayer compliance, and strengthen tax administration capacity. So you can see most of the focus of the government is on tax, not on spending. Okay, and it's not about increasing taxes, it's about generating revenue through a broad-based tax approach. Part of what they're also looking at is introducing an electronic invoicing system by January 2024 to try and make VAT much easier to manage. The government is also looking at investing in technology because they're saying that they're trying to phase out these manual receipts, which have created a problem. They've created corruption, they've created all sorts of things, and they want to make sure that all government payments are done through integrated financial information system. They want to make sure that land administration is also an integrated system because they know that land is where a lot of the corruption starts to happen. Business registration system should also be as digital and as well managed as possible, because everybody will tell you that some of these processes we've seen at PACRA they've worked. We have seen an improvement, but of late people have been complaining about whenever they're trying to do registrations, there have been issues. Okay, online management has been filled with issues. I'll give you one thing: tax payment is one thing that has become very easy in Zambia. You can actually even register somebody on ZRA using a USSD code. I've actually done that recently, and that's a huge change, by the way. So there are improved avenues of tax compliance in this country. Whether you can do it through your phone, you can do it online, you can actually do all your payments, be it NAPSA, ZRA. Collecting money in those areas has actually been quite simple. In fact, even generating your PIN, paying with mobile money, the integration has actually been quite excellent there. Road traffic system management, I know that they're trying to work on that. I know that the payments in terms of your taxes, in terms of your license, all those things, you can do it on the government bus. The problem is that the administration of these things has to be done through a central thing. I've always said, Stephanie, for the life of me, I don't understand why we still have to use the stickers. Why we can't just scan license plates from now on. It would actually be much easier for the police just sit there with the scanner and just scan your license plate number, and then just be able to just check in their system. What's up to date? Your fitness is up to date.
Yeah,
What's expired? What's not? It would actually be an easier system, except we just have this need to put those stickers on cars. That those are some of the manual things that we need to start removing. And one of the things I have pointed out, for example, when it comes to road fitness, one of the ways that would do two things: it would create jobs and it would improve road fitness, would be to decentralize road fitness, fitness to what's it called, fitment centers, to actually go to all the private fitment centers, partner between RTSA and the private fitment centers to actually start saying, can we start doing fitness testing at these areas now? I know in South Africa they run that system where your private fitness, your fitment centers can actually do your road fitness certification. Now, if you can give that power to the fitment centers, now I know everyone is concerned that there'll be bribery and corruption, then it becomes RTSA's job to then go and now start monitoring the fitment centers. The reason is it takes away a lot of the congestion from areas like Mimosa, where people are trying to do a lot of that testing. And two, if you give fitment centers a lot of that, one, they'll be getting more servicing revenue, and two, they'll have to hire a lot more mechanics. That's a lot more hand-skilled laborers who will now have full-time paying jobs, because people will be going to their mechanics for their fitness. Well, not just their independent mechanics, but they'll be going to the actual fitment centers for that, and it'll actually create a strong boost in the fitment center industry. Okay, so that subsector of the economy can actually grow. So if they want to improve the road traffic management, decentralization of the fitness testing towards private fitment centers would actually be a very good thing. And it's an easy thing to implement because the majority of cars in this country are sitting in Lusaka anyway. The majority of cars in Zambia are sitting in Lusaka. So it's actually one area where you just need to implement it first. You can start with a Lusaka program. Then you can start to flock it out into some of the line of rail, such as Copperbelt after that, and then you start to broaden it further and further. But if you slowly, gradually do this, you can actually create a lot of jobs in the mechanics sector. That will actually improve a lot of their output. That's just something that I've put into my mind. The ZRA they've also said, as the government, they want to streamline granting of tax incentives and concentrate more on consumption taxes such as excise duties. So they really want to try and make sure that it's the things that we're importing where the taxes are going to be collected off of, and strategically some of those things. that we're importing. Obviously, things like solar panels, we want to try and give a lot of tax incentives so that people can have alternative energy in their homes. That's part of what we want to see and want to do. Now, if you're looking at their budget going forward, altogether, one of the simple things that we are seeing here is that there is a growth in tax revenue that they're targeting. And the main line of tax revenue growth you're expecting to see is really in value added taxes and custom duties. You can see that those two combined are expected to move from 42 billion kwacha all the way up to about 66 billion kwacha. That's a 50% increase that they're expecting to see, while you're also seeing even income taxes expected to grow from 50 to 78. Mineral royalties are where you're going to see a little bit of stagnated growth. That's only expected to move from 8 billion to 11 billion. So there you can see that that's where they're not really pressing the needle as much, though you can also see that non-tax revenue is expected to grow. But really what they're trying to do is make sure they grow the tax base so that they can increase they can increase tax revenue. You can see they're not really pushing for grants as much. Now, if you're looking at the government financing strategy, if you're a bond investor, this is where you are paying the closest attention to. If you're looking at where to put your wealth portfolio, this is where you pay the closest and deepest attention. The government's going to continue implementing a moratorium on commercial loans until 2025. Okay, so no borrowing at commercial rates until 2025. That's the government's goal. They're also going to do concessional borrowing only. So, in other words, that's your World Bank, IMF. Those are the only sources. So, they're only going to be getting external credit from concessional, and they're going to continue contracting debt domestically through the issuance of bonds and treasury bills, but not at the expense of the private sector. So, that's an important point. When they say not at the expense of the private sector, what they're trying to say is they're going to control the interest rates that they're going to be accepting at bond auctions, because they don't want private people to be getting high interest rates. And also, they don't want to take money out of the banking system that should be going to businesses and business growth. So they really want to do that. They want to leverage PPP. So instead of borrowing to build a road, they'll see if they can partner to build a road. Instead of borrowing to build a power station, they'll bring in an equity partner to invest in a power station. So this is what they're going to be doing. Instead of trying to push the government to lend money and do things, they're going to try and stimulate the private sector to get more involved in these sectors of the economy. But if you're really, here's the part you pay the most attention to: the government is looking to limit domestic borrowing to no more than 2.2% of GDP by 2026. Currently, we're at 2.9%. Before, we're at actually quite high levels. So the government wants to make sure that it is, in terms of what it's getting from bond auctions and treasury bill auctions, it is not getting more than 2.2% of GDP, meaning that restriction means that even at auctions, you will expect interest rates have peaked and the pressure will start coming down. So if the government is borrowing less, expect interest rates to start coming down somewhere around that 2026 area. So this is why you grab all you can at the high yield, and then you slowly start to drift into your stock markets and you diversify your savings from there. And finally, looking at the government's financing strategy, if you look very carefully, as I said, if you look at their external financing, currently they're getting more money from net external financing than domestic. And you'll see that they're going to be switching to the point where, in terms of borrowing, they're going to be borrowing more domestically than they will be internationally. So 2024, 2025, 2026, you can see gradually they're going to phase down international borrowing all the way down to 1.9 billion kwacha, while domestic borrowing is going to stay flat. So the government spending is going to be driven by economic performance and tax. So the government is all about economic growth. If it can get the economy to grow, then it can generate money from taxes. So this is them saying, we are planning on spending according to what we are making. We are not going to start spending all over the place. We are going to spend according to our means. Now, in terms of where they're going to be allocating money, so if you're looking at the hotspots of where they're going to be allocating money, you can see that general services is expected to come down, mainly because of the debt reduction in debt payments, especially external debt. But you can see the rest of them, be it defense, public order, housing and amenities, health, education, you can see that they're all staying flat. So every area's allocations are going to be expected to stay the same in terms of the percentage budget allocations. Now, I know this doesn't sit right with all the activists, pump your fists up, shouting in the air, all of this. But the reality is we are in a situation where we're repaying debt and we need our economy to grow. So you can see the only place where they're going to reallocate the savings from general public services is going to be into economic affairs. And remember, economic affairs is where a lot of the infrastructure, the growth, the economic activity of this country. So you can even see it in their spending that they're going to be targeting a lot more of the revenue that they're going to be collecting towards economic stimulation. Okay, not to social welfare only. That doesn't mean that they're going to cut social spending. They're just saying that they're going to keep everything flat, and any savings they get, they're going to channel it into economic growth. Okay, so that is what they're going to start talking about. Whether it's developing of the infrastructure of the economy, whether it's CDF programs to try and help with stimulating low-level economic growth or decentralization, whether it's even trying to transition from FISP to CAS-TP, as they're calling it now, where they're trying to do comprehensive agricultural support. All these things are now to make sure that taxes are going to go to stimulation of growth. Okay? So that is the central focus that the government is going to have. Finally, Stephanie, I'm going to be getting into the daily deep dive. So for everyone, that is the breakdown of the medium-term paper and what it looks like from an investor's perspective. And so I will give you from my perspective, so from my viewpoint of what this means for those of you who are looking at where to invest your money is this. In the short term of this year, growth is not expected to be strong. Your mining sector is in a recession. Your export sector is in a recession. That's not expected to pick up yet. Remember, I've said Zambia is on the cusp of the greatest wealth expansion because it's going to go into an economic growth super cycle. That's not going to happen tomorrow. That's going to happen gradually over a period of time, probably on the other side of 2025 going into 2026. That is when we're probably expected to see above average economic growth and probably getting back to that 6-7% economic growth where East Africa is. Now we can start finally matching with where East Africa is. And inflation is continuing to trend downwards. Global prices are starting to come down. That is correct. Global food prices are coming down. Global fuel prices are coming down. Global prices in general are coming down. So you are seeing a slowdown in inflation, meaning interest rates are not going to rise any further. But you're also still seeing a short-term slowdown in growth, meaning they're also not going to drop instantly. So they look like they're going to be sticky here for a little bit of time. The stock market is having a slow move out of the gate. After 2 record sessions of growth on the stock market, it is moving slowly out of the gate this year. So expect the stock market to probably close a little bit slower. One, because the stocks are not underpriced anymore. I don't see the stocks on the stock market being underpriced anymore. The value of companies has now reflated back to full real price. So it's really the ones with growth expectations. So with growth slow, I don't expect the stock market to rise any faster in the second half of the year. Probably going into 2026, 2025, 2026, that's when I'm really now ripping my mind into the stock market rally. That's probably where we're seeing this picking up. But it's not a bad idea to start picking them up while they're ready and looking for the ones with growth opportunities. So you can't just broadly pick up any counter on the stock market. You're going to have to be strategic about what stocks you start to pick up. But for now, build your fixed income base. That's what this is telling you. Build your strong fixed income base and then slowly and strategically diversify. So if you are buying up bonds, this is a time to start eyeing some of the bargain stocks, the ones with growth opportunities, not just underpriced stocks, but the ones which are underpriced with growth expectations. The ones which are strongly underpriced and have got good top line revenue growth coming. That's really what you want to pay attention to. And the ones which are less exposed to too much borrowing. They're not overly leveraged. That's one thing you want to start looking for. And on the other side, you're also looking for dividend-paying stocks also. This is the same strategy I've been telling people for the last year and the year before, you really want to build out your short-term bonds, your medium-term bonds of 2 to 5 years, and also slowly start to diversify into dividend-paying stocks, which are underpriced and can give you a healthy growth overall. And finally, so what you start to see is probably on the flip side of 2020, 2025 is when you'll probably see your property sector also pick up, because that is when interest rates will now finally probably start to pull down. The retail interest rates will probably start to pull down, and a lot more capital will start getting towards activities for construction, because right now construction is also a weak economic sector going forward. So that was the deep dive into the economic outlook of the economy. More questions that you may have, people, sit down and go through that data, replay this, going over and over and over again. That was me going in depth into that market. So I'll probably want to call a break here. And to everyone, thank you very much. Stephanie, thank you for being a wonderful co-pilot.
Definitely.
Okay.
Well,
All right. So I think that's a sign off from me and a sign off from Stephanie. I will be seeing you all tomorrow when we'll be doing Enterprise. We'll be talking more about teamwork. So have a wonderful day.